Welcome to Hitting Home with Mike and Arif. And if you are a regular viewer of Hitting Home with Mike and Arif, you know we focus quite a bit on real estate and housing and houses. And me being a real estate agent, you being a mortgage broker, we try to find some balance in there and focus on the numbers, focus on the financing. And this is a show where we're going to do primarily that. And we're going to turn it over to you for the most part here.
Are you leaving?
I'm going to stick around for support if you need it there.
Support, I'll take it.
I'll inject, I'll try to throw you off a little bit. But let's talk financing, and there couldn't be a better time, and you can tell us why.
I think it is a fantastic time to do it. I mean, listen, as far as in my world, it's a daily conversation.
Mm-hmm.
I'm always looking, as you know, at the news, at the headlines, and that's great. The headlines are what they are, but then I like to get into what's behind the headlines. What is the cause of what we're talking about in the world today at any given point? So could be looking at bond rates, could be looking at interest rates, could be looking at inflation, could be looking at all sorts of things. But how does it apply to you at home? How does it apply in your world? That's my job, to try and make sense of it. And I think just by way of sort of creating an expectation for what we might cover today, and I appreciate the opportunity to do this with you, is I think it is important to keep things in context. Mm-hmm. So in an effort to keep things in context, what I'm looking to do and hoping to do with you today is talk a little bit about where we were, then where we are, and then where we might be going, but apply some context even around that.
For sure.
Being, I think it is important. I mean, anybody reading the headlines, you read one paper, it'll say one thing, another paper, it might say another thing. It's important to realize that those numbers, they may be fact, and they may have impact and influence, but how it impacts different people at different stages in their lives, and maybe different people with different sort of backgrounds and capabilities, that impact or the amount or measure of impact might be different.
All right. Well, here's an opportunity for us to get a little nostalgic here. Let's talk a little bit about where we've been that's brought us to today here.
Absolutely.
Certainly from your perspective as a mortgage broker.
Perfect. Well, listen, I mean, one of the things that I think anybody who has watched this show, and certainly you're welcome to go back through the archives or you catch us on YouTube or wherever you find our information, is that even as early as 5 years ago, we were talking about financial responsibility, being due diligent. What do we do? What is the best advice that we could give now that rates are theoretically historically low? And when I'm talking about now, I'm talking about 4 or 5 years ago, even as much as 2 years ago, when rates were near historically low levels.
Yeah.
Okay, so one of the things that would come to someone's mind is, hey, rates are low, this is fantastic, I'm gonna go buy as much house as I can.
Yeah.
And what we've got to do is be a little bit careful, because I think it's a very fair statement to make that if I'm talking to a salesperson, whether it's at a car dealership or whether it's somebody who's going to pull my credit, they're going to say, hey, listen, how much car can I get you into? Right? Oh, you earn this much money and your credit's great? Well, I can get you into this car.
Right.
And that's great from their perspective. They're going to sell a nicer car. They're going to give you a period of a honeymoon where you're going to enjoy that car, that new car smell. But eventually, and it's usually around the time of that first ding or dent or scratch on the car, and then all of a sudden it's just a car. Yeah. And now you're in that situation. Well, the same kind of thing happens with houses, right? And so talking about historically low rates, my approach was, and attitude is, still today, rates are low, and that's great, fantastic. What does that lead to opportunity? Well, a couple of things, Mike. We talked about it before we started the show, and that was around, well, if I can access rates for a low amount, maybe I can turn that into an investment. And maybe that investment is something that will pay me a return on that investment, and it'll cash flow itself.
Some did that. I mean, reality being that that's a smaller segment of the population that is leveraging and making money off of that, and it's one of the things we talk about, and real estate's one of the better vehicles for that.
But you're right. There's a segment of the population that's using the home purchase for their own use, enjoyment, and security and safety and necessity to take care of themselves or their family, etc. There is a smaller component that says, here's an opportunity to invest. Okay. Then there's the other side.
Some have done well. Some have I've worked with a number of people that it's impressive to see what they've been able to accomplish over the last 10 years or more by reinvesting their money or leveraging their existing investments in order to broaden the scope of what their investments are. And
exactly, Mike. I think it's important that we say again about context for the individual who is treating real estate as an investment, which is generally a smaller segment of the population. I'm not talking about just the average person who has a second property, but actually as an investor. And they're looking at it as a vehicle. Absolutely, leveraging low rates for a return and an opportunity is a great idea. But that doesn't actually speak to the vast majority of people. The vast majority of people are looking at home ownership as
their primary residence.
Their primary residence, protect my family, protect myself, a roof over our heads, hope to have some equity, hope to have an appreciating asset, but we're really looking at it for personal use. And again, that's why we've talked about, for anybody who's really watched our show over the last several years, I think we'll agree that we have provided an ounce of caution, a bit of a tempering of the enthusiasm and the excitement around this whole concept of near historically low interest rates. And what I want to talk about just for a moment is, and it doesn't do any good to do an I told you so moment. It doesn't do any good to browbeat somebody. But we recently had on the show a great guy, and for some at first we were like, well, what is he going to be doing as a guest on the show? But he was a phenomenal guest for us.
One of our many?
One of our many. They're all great, Mike, absolutely. But we had Dr. Brad Dibble on the show, and he's a cardiologist, world-renowned cardiologist. And I really loved his approach because he said, folks, I can be a doctor and I can say, what are you doing smoking? We've known long enough that smoking's bad for you. You need to watch your calcification and your buildup in your clogged arteries, and you need to practice good dietary health and exercise, et cetera, et cetera. But that doesn't necessarily get the buy-in of people. And so his approach was really around hey, let's talk about what your goals and ambitions are in life. What would you like to have as an outcome? And then let me help you, guide you to get there, but it's still on you. When it comes to interest rates, especially in the last 5 years until about a year ago, our approach had to be something similar. We have to put faith and responsibility in the individual. But the average person, and I'm going to use the term average, statistically average person, actually was biting off more than they could chew. And they did so thinking the glory days are never going to end.
No, they've been here for the last 10 years. They'll be here for another 10. And it's like in our youth, we don't, we'll go and we'll eat that greasy burger or whatever, and we're not worried about down there. It's only when you're getting closer to that change or that critical crisis that you start to think a little more about protecting yourself.
Exactly.
And that financial glass ceiling has been creeping down on us recently. So.
Exactly. So where we were, Mike, I agree with you 100%. Where we were, and I think we have to put things into that context, is we were saying, hey, listen, if you look back over the history of time since we've been following these trends, certainly 50 years plus that we've been following these numbers, we knew that we were more than 7 years into a 7-year traditional recession cycle or interest rate cycle as well.
We commented on it, and the media's commented on it, and it was unprecedented, the length of time that we remained in that cycle.
Absolutely, absolutely. So where we were, Mike, is we were at a point where people were buying with a false sense of confidence, and we did caution about that, a false sense of confidence that I'm going to buy this home, or I'm going to refinance, or I'm going to spend my money. And this is the thing, it wasn't, remember, real estate and finance is not always about the finance of the real estate. Because there are people who have utilized their homes.
Oh, and the equity for sure.
And the equity of their homes, the appreciation. So during the same period.
Vacation, whatever,
So during this same period, we saw historically low rates within the housing sector. We saw homes that increased in value. Because we saw supply and demand concerns that increased that home's value. So it created a sense of equity. But what is equity? I'm going to get all philosophical for a moment, or whatever you want to call it. Just for a second, what is
It's not
equity?
In your pocket. You can't spend your equity.
Unless you sell the home, the equity's not yours. It's only an approximation.
Or sell a share of it to the bank, which is what you're essentially doing when you take a line of credit.
So where we were, Mike, absolutely, we're in a period where, and this is, I will say this is the fault of regulators and government. Allowing easy access to bad debt, I'm going to call it bad, meaning credit cards, cars, in-store financing,
just
don't
consumer
pay
purchasing,
events, consumer purchasing, allowing
buy today,
people
pay tomorrow.
easy access to non-appreciating assets, easy access to really liabilities, and over a period of time making it harder and harder, as we are here today, to access credit for a good debt, for an appreciating asset.
Because they look at all of those, you know, those spontaneous purchases that you made over the last 4 years when they're qualifying you for your renewal.
Absolutely. So, Mike, this has nothing necessarily to do with today. We're still in the where we were phase, okay? And where we were was a culture, generational culture, that allowed people to believe a false sense of security that they would forever have access, and maybe not forever, but you know what, I'll deal with it tomorrow was an attitude, right?
Yeah.
So I'll buy what I want today. I don't have the cash in my pocket for it today, but I do have access to this piece of plastic that allows me to buy that thing today. And then for people to rack up their debts at 19 to, some people down at 12.5% or 9.99, but the average person sitting at 19.9, and the average person who misses a payment suddenly goes to 24.99%, right? And then suddenly deciding, I've maxed out my credit, I'm not making the income, but I'm going to tap into my home. And I'm going to take some of that equity that I have in my house and I'm going to consolidate. And really that's where we were, Mike, is we have a combination of people who are accessing ultra low rates with a false sense of security, buying more home than we truly, if we really thought about it, needed.
But I think that mindset has shifted. There's been financial pressure, but I just think in general that mindset has shifted. More is not necessarily better with regards to home. I think people are looking for quality over quantity at this point. So
absolutely. So we're going to go to break in just a second, but that's an interesting conversation to have because again, what I want to hit home on the fact is that not all conversations around mortgages and financing have had to do directly with the house. But sometimes it has had to do with, yes, maybe I've shifted my expectations on my home. Some didn't, and we're going to talk about that in the next session when we come back. We're going to talk about some real wake-up scenarios that people have had. But other people have been going on vacations or buying that car or turning in that leased vehicle or whatever it may be, accessing the other niceties and then utilizing their home to pay for it. And then refinance and consolidate that debt.
I'm excited, and I'm going to hang in there, and I hope all of you hang in there for that too. We'll be right back after this break, and we'll talk a little bit about where we are today and how we got here. Welcome back to Hitting Home with Mike and Arif, and we're talking with our resident expert on real estate mortgage financing, Arif Khan, and we're talking about where we were in that first segment, and we're going to talk a little bit about where we are today and where we're headed. Take it away, Arif.
Absolutely. So just by way of brief summary, again, context matters, and I think anybody who's sitting here today reading the headlines is maybe reading the headlines with a little bit of a different taste in their mouth than they were maybe a year ago, maybe
hey, this applies to me.
Maybe before a year ago. Absolutely. And to be fair, and let's be fair, there are different people at different stages in their lives and different people who are differently positioned to be able to weather the good times and the tougher times, et cetera. But we want to speak to, let's call it, the majority of people who would agree that regardless of where you are in life and what your financial position is, seeing an increase of 400% in the prime lending rate and the impact of that on your financing, on your mortgage financing forever, for anybody really who's carrying any form of mortgage debt, it's going to have an impact.
Yeah.
Doesn't mean it's going to put you in dire straits necessarily, but it's going to have an impact.
I fully agree. I just want to, on a technical point, I want you to explain something, because you've referenced this in the past, and I just wonder when some people hear it, if they fully comprehend it. When you say a 400% increase, some would go, oh, wait a minute, no, we only had like a 4% increase because we went from 1.5% to 5.5%. Explain why that's a 400% increase.
Yes, yeah,
it's simple
great.
math, but it's worthy of...
No, it's a good point, Mike. I think it absolutely is a good point. I think you have to put things in context. When you see your the prime lending rate go from 2% to 4%, that's a doubling.
That's a doubling.
That's not a 2% increase.
No.
That's a 200%. It's a 100% increase, but it is 200% of what it was before.
Yeah.
Right?
Yeah.
So again, context matters. So when people think, oh, interest rates are still low, yes, they are. But what is the significance of it?
Yeah.
And it's not about the interest rate, it's about the compounded effect of the interest rate. And we're going to get into that. Sorry, you just about lured me into going down this rabbit hole on the impact of cash flow, and we'll get to that in just a moment.
Yeah.
But I think what is critically important, Mike, if we were to look at where we are today, and I want to put things again into that perspective, we effectively, in 90 days, went from policymakers and people in position of influence, whether that's the government, people standing in front of a podium saying, times are good, don't worry about it. No, the economy is strong. Look at the jobs report. The jobs report's fantastic. They had an interest in making sure that they continued to breed confidence. You'll recall, it was about 2 years ago.
We're getting a lot of mixed messages today, too.
Exactly. And it was about 2 years ago that the government told the business community, stop hoarding your cash, spend it, inject it, infuse it into the economy. Well, what was the business community? We talk a lot, Mike, about the manipulation, the impact of
their
manipulation.
numbers, not our numbers.
Exactly. We talk about the impact of manipulation, and then we always come back and say, let the market do its thing. Well, the market was doing its thing by sitting on the cash because they were anticipating something's not adding up here. The numbers aren't working. We're way too long on this. The government isn't collecting tax revenue. They're spending. They're giving out subsidies in the form of CERB payments, other forms of subsidies, and we're also printing cash.
Yeah.
And we're printing more cash and we're not collecting it back. What's the plan for repayment? So those in the business world were saying, we're going to watch this a little bit. Meanwhile, there were people standing at podiums saying, don't worry, keep going, invest your money, spend your money.
In fact, we'll give you a few $100s. We'll add to that.
We'll give you $500 to your grocery bill.
Double down on that and go out and spend even more.
Right.
But life is good and we'll always be there for you.
Then, almost as if it was overnight, because literally almost as if it was overnight, in about March a year ago, literally the government and the Bank of Canada governor decided we're going to start jacking rates. And they didn't just trickle it up a quarter basis point at a time. And again, my goal is not to rehash things that we've talked about before, but we have been encouraging that these artificially low rates are not sustainable.
No.
Now is the time to inch them up over a period of time. But what they decided to do was, in a period of really effectively 90 days to 180 days, double the lending rate.
Yeah.
So there were people who literally had wet ink on contracts agreeing to buy a house, having just been approved and qualified or pre-qualified, but pre-qualification actually means absolutely nothing. So qualified,
right,
and literally bound themselves to a contract with an anticipation that they were going to get access to a certain amount of money called the mortgage at a certain rate.
And over that 30 or 60, 90 days to closing, the world changed.
The world changed. And historically, and we've been saying this, yesterday's performance is not necessarily indicative of tomorrow, the reality for tomorrow. You've seen that in any investment bank or whatever. But historically, people have chosen the variable rate mortgage because historically it has been a little bit better.
A little bit lower,
a little bit lower to carry.
Because there was no anticipation of rates going up.
So for somebody who locked into a 5-year contract at a slightly higher than the variable rate mortgage, maybe at 2.45% or something like that, they're good for 5 years.
Yeah.
They can ride the wave of wherever we are today because that's what they're going to be paying. But for somebody who said, no, I'm going to take advantage of that extra 0.25% benefit of going variable, and overnight they went up. They're in trouble. So these are people who actually, you may have heard the term called it encroached on, or it hit that trigger point. And there's a trigger point in there, because when you have a mortgage that is designed that whether the interest rates go up or down, your payment stays the same, there's an implication of that.
To a point. There's a red flag that's triggered in there.
There is a flag that is triggered in there, and by law, you cannot have 100% of your payment only go towards the interest, and none of it go towards the repayment of principal. So when you're hearing in the news the banks are concerned about people encroaching on their trigger rate, that's what they're talking about, because we agreed to a fixed payment. Payment stays the same for the term of the mortgage, whether it's 1 year, 2 years, 5 years, something like that. But suddenly, the compound effect of interest, because your mortgage rate was tied to prime at a prime plus or minus, but if prime moved, so did the impact, the compounding effect on your repayment. People were actually finding themselves upside down on their mortgage, and that's not allowed.
Lenders were effectively loan sharks at that point.
That is not allowed under the law.
No.
Okay, so that's something that we have to talk about, is where we are today. Is we're at a point where people we wanted to apply caution, we wanted to apply a sense of tempering of spending, because we were noticing some statistically unhealthy habits going on out there, that jobs and salaries weren't keeping up with inflation. Inflation hit nearly 9%. What does 9% mean? In the building industry, it wasn't 9%. A piece of plywood going for $300 is not a 9% inflation impact, right? So all of these impacts,
a number of things put us to that tipping point.
Started to come home to roost, and people have mass debt. They've gone on vacations because they were cooped up for 3 years, and they said, I'm out of here. Let's go.
I'm living like there's no tomorrow for the next year.
Exactly.
A lot of us did that.
So a lot of people tapped into their credit cards. A lot of people tapped into their credit cards to live a little bit. They did their pool. They did their landscaping. They did their home renovation. All good things.
And our leaders were coaching us on this.
Absolutely.
They were buying rounds. They were telling us, get out there and spend that money.
Absolutely.
Shop local, support your economy.
And that is some of the worst advice that they could have absolutely given, because they set the expectation for people who bought it, hook, line, and sinker, basically to say, this is how it's going to be. Right? And that is not what ended up happening. Now, when you've heard me caution before, and I think we both agree, watch the headlines. Careful what the headlines say, because the headline isn't necessarily speaking to you. The headline doesn't know you that intimately.
The worst case scenario, the broad scenario, oftentimes it doesn't apply locally or specifically to you. So you always have to temper what you're reading there and see where and how it applies.
Exactly.
So we've talked on that many times.
So here's something that didn't change. Okay, what didn't change is that people buying on credit, which is buy now, pay later, basically, there's an implication to buy now, pay later. It means you're going to pay interest. So we talked about this before, but here's the fact, all right? Regulators and policy and government in this country have made it much easier to access bad debt than they have to access good debt. And now, though, the big caution was, we're concerned about inflation. Inflation meaning we actually subsidized our economy by printing money and handing out subsidy checks while times were tough and people couldn't manage their businesses the way they were. So that's what actually created the inflation. So it was more dollars that were worth less than they were yesterday were required to buy the same product. That's really what inflation happened. But now the government's concerned about it. They're concerned about inflation, and they're concerned about the fact that Canadians, unlike Americans, by the way, who have seen their usage of debt actually decrease, oddly. I didn't realize that, but I just read some statistics that were quite fascinating. Canadians have actually tapped into higher amounts. We have the highest level of household debt in the entire G7.
I think the American government made the shift from speaking like they were party planner or tour guide operator to speaking a little more like our grandparents might have spoke to us with regards to finances. They started to make that shift a little sooner than Canada has. We've had our Canadian government continued, even as things were in the midst of shifting, telling us and providing financial incentives, and that I think throw people off. Well, if the government's giving me a check for $500, everything must be good overall, otherwise this wouldn't be happening.
Trust the government. Well, and those are words that I wouldn't necessarily encourage to do so blindly.
No.
Because, again, Headlines are headlines and facts are facts, and they can be interpreted different ways. Here's the fact. Whatever you're feeling at home, that's your reality. That's your fact. If your income hasn't gone up, and if your house value has suddenly dropped by 15, 20, 25%, well, the fact is that people were racking up credit cards at 19% interest and then calling their broker or their bank and saying, I want to consolidate, I want to use some of the equity. In other words, I'm not going to change my behavior, but I've got this free bank account sitting here with some extra cash in it, make my problems go away. And here's a reality check for people, all of us included. When you tap into equity, we talked about this before, remember, equity is this seemingly sort of fictitious number that is an approximation that doesn't actually come true and materialize until you put a sold sign on your home and you cash out. That's what equity actually is.
Well, you have to officially be homeless in order to have the money in your pocket effectively.
Exactly. So a year ago, when prices of homes were at their highest in this incredible...
By homeless, I mean you have to sell out, cash out.
Good clarification. Okay. So a year ago, when prices were at their highest and people were trading homes at the highest level historically, you had all this equity
with impunity.
Now
just
you went,
left
you
and
didn't
right.
sell. You didn't sell, and you chose to take your bad debt, so to speak, your credit card debt, and wash it and make it disappear by tapping into your equity. But suddenly your house is worth less now, and it's coming time to renewal. Now we're going to have that conversation. So we got to go to break, but let's talk about what's happened to people who have followed this trajectory. And of course, there is a bit of I don't want to call it necessarily a silver lining, but what are we going to do about it? Really is something that we have to talk about.
And many who haven't come up in the last year since things changed for that renewal on their mortgage will be coming up in the next while. So talk to us and reassure us, not just necessarily reassure us, tell us how we can best reach that date. Give us some advice on that.
We'll be right back after this break.
Welcome back to Hitting Home with Mike and Arif, and we're talking about financing, and we're talking with mortgage broker Arif Khan here, who this is your wheelhouse. Once again, you know, and you're dealing with people on a daily basis who are coming to you with questions. We kind of approached the break talking about the fact that, many people for a while felt a lingering sense of security. They'd locked in on a lower mortgage rate before the rate started to go up. But most will have, the most popular term is a 4-year term. Some will do 5, some will do shorter, but a 4-year term. So at some point, people are going to hit that point. They're going to have to renew. Many things can and would have changed. Many things outside of their door have changed with regards to financing, but many things have probably changed within their home too with regards to their own financing. So the big question I want to ask you is, I'm going to be facing a renewal in 6 months, let's say. What would you advise me to do, or what should I have been doing all along even, that's going to make that day a little less intimidating when it comes?
Yeah, great question, Mike. Well, I don't think I'm going to be as gentle as the setup for it, but go with me on this. I think, first of all, we, as a society, we enjoy being marketed to. And when I say that,
we're at least used to it, for sure.
Nobody wants to be sold. Everybody wants to buy. But we want people to make us feel good.
We like to feel needed.
Yeah, we like to feel needed, but we also want people to make us feel good. Like, you're going to buy your dream home. And you are.
You will look good behind the wheel of that car.
Absolutely. Imagine yourself sitting behind the wheel of this car, right? Here's the thing. I love to be positive. I love to be optimistic, but I also force myself to be realistic. And so forget about today. This is information that I would have said to anybody 10 years ago, 15 years ago, and I will say it to them tomorrow. First of all, where we are today isn't going to stick around forever, but it is your reality right now. If you're coming up for renewal, it's your reality right now.
And in all likelihood for at least the next year.
Oh, for sure. Absolutely. So here's something that I would have said to anybody 15 years ago, and I'll say it to them today. You're about to make this purchase. That's fantastic, and I'm excited for you, and I want you to be happy. I want you to have everything.
Purchase being a home?
A home. Let's go with a home. I want you to be happy. Here's the fact, okay? The fact is, where you are today could change overnight. So, I am not a doomsday seller.
Yeah.
But unless you set yourself up with a security blanket or a plan B, you've got to meet this obligation. And so one of the things that I've said to people all along is, the world of mortgages is not about, and this is a big misconception, it is not about what does it take to get me into this house, like they say about a car. What's it going to take to get you into this car? It's not about what's it going to take to get me into this house. You don't buy this house today and you're done unless you're coming in with a cash offer or a cash purchase, right? You have to qualify for the house today, and you have to know that you've got confidence that you're going to be able to meet your daily, monthly, regular obligation for the period of the duration until you owe nothing on that home. Because in most case scenarios, a person will have put down anywhere between 5 and 20% for a home. Which means you owe anywhere between 80 and 95% of the home over the next 25 years or so. Okay? So you buying a house today, congratulations, but that's not the end. That's just the beginning. You've got to make sure that you can service this obligation, the property taxes, meet all the obligations of keeping insurance and upkeep and maintenance on the home for the duration of the time that you own it, either for until you owe nothing on it or until you sell it and owe nothing on it. Okay? So in terms of mortgages and financing, the same applies today. For somebody who bought a home where maybe rates were sitting at prime minus 0.9, okay, I know people who were paying literally 0.5% for interest, or 1%, or 1.5% interest. And now the average interest rate today for you to qualify for a new mortgage or for you to qualify for a refinance, which is a remortgage, a new contract on your mortgage, you're sitting on anywhere between 4.85% and 5.35% for someone with great credit. For someone who qualified a year ago or maybe 5 years ago for that 1% on average mortgage, or even at 2%, they're now having to qualify at 5%. Okay, so what is the impact of that? What does that actually mean? It means that congratulations, you have now been qualified to live in your house for the duration of this contract until your contract comes up for renewal, and you have to qualify to stay in your own home.
You do.
And,
now,
and this
are
is
you,
not something that people think
on
about.
On a refinance, are you having to qualify at precisely the rate, or have we got what the government has put in the buffer? You have to qualify at 2% higher than that for the refinance.
So
great
for question.
For a first-time buy-in.
Great question. So you have to answer. So a couple things are going to happen for you at renewal time. At the end, let me rephrase that. A couple things are going to happen for you at the time that your current contract comes to an end, whether it's 1, 2, 3, 4, 5 years, et cetera. Okay. And that is that you're typically going to get an offer to renew as long as you didn't miss any payments. And if you missed a payment, or if you missed 2 payments, you may not get an offer to renew. So over the last 3 years, times are tight. And if your employment status changed, or if your self-employment status changed, if your capacity to service your debts changed, and you started missing payments or you started seeing stress, you may or may not get an offer to renew. But let's say you do get an offer to renew. It'll be at today's rate. Now, it actually won't even be at today's rate. In many instances, the financial institution's not going to give you, it's kind of like getting a cell phone. Why is it that if I've had a cell phone for 20 years with the same company and their color is either blue or red or orange or whatever it is, they're offering new customers a better deal than they're offering me? Why is that the fact? Well, it's the same thing in the mortgage world. You will often see that your interest rate comes in a little higher than what you could get if you went and rolled the dice and went to a broker, an agent, or the bank branch.
They don't have to entice you.
They already have you. They don't have to entice you. They know that you're going to have to get an appraisal. You're going to have to requalify. You're going to have to show your taxes. You're going to have to go through the hoops. You're going to have to pay a lawyer. You're going to have to go through a whole bunch of things that add up to at least a few $1,000s in order to go somewhere else. So they know that. So they're not forced to offer you the best rate on the street. So whatever it is, though, you do have to qualify. So you may, here's one thing that's going to happen. insert disclaimer in your own word, in your own world as you receive this information that I'm going to say. This is what people are doing, not what I'm advising. You're going to get an offer in the mail or by fax or email or something like that.
Yeah.
And you're going to have to sign a statutory declaration that says, nothing in my world has changed, and I believe that I can hold myself accountable to meet the obligations that you're presenting, and I am selecting this 1 year, 2 year, 3 year option, fixed or variable. Now, you are now committing to meet that obligation. All right? But if in fact something has changed in your world, you can sign the paper all you want. At the end of the day, the payment's coming out next month.
Yeah.
And if your world is such that your rate went up from 2.5% to 6.5%, which it did for some.
And what would that look like? Say your outstanding mortgage is, just to pick a round number, $500,000.
Your payment could go up by about 40%.
Okay.
Let's just use that as an average number.
Okay.
Many people have seen their payment go up
So
by
if
40%.
if you were paying $2,000 a month, say was your mortgage payment, add another.
Add
another
anywhere
$800
between
to
$500 to
that.
$800 on that.
Yeah.
Absolutely.
Yeah.
and
Which is
this
significant for many.
It's absolutely significant, especially if you were the person who didn't buy what you needed but bought what you wanted and thought you'd figure out how to keep it.
Yeah, and bought as close to the line as you could qualify for in those easier times and terms. Yeah.
And remember, in qualifying, it didn't factor into the equation that you might need to replace an air conditioner or a furnace,
Or you might
put a roof
break a
on
leg
it,
and be off work for a few months. And,
or you might get divorced. Someone might be deceased. You might be you might get COVID. You might be in a long-term disability.
many things.
Or your company may shut down.
Yeah.
Here's something that's so important for people to put into perspective. Okay, this is a statistic. It's not my opinion. Right? We're looking at above 85% of the population works for small business. So all these super corporations that people talk about, most people don't work for them. They might be large employers, but not everybody works for them.
Yeah.
But the same person who you're working for, that company that you're working for, if they're a smaller employer, what's moving 97% of the economy is typically smaller business, okay? Well, what if the owner of that small business runs into financial hardship?
Yeah.
What if you were managing your things okay, your life okay, but that small business ran into financial hardship? You might be out of a job.
Happens again and again, yeah.
Right? You might be downsized. And that's why I say be careful about watching the headlines. First of all, the headlines are always 90 days behind schedule, if not worse. The government is saying recession, what recession? Meanwhile, the stats are saying we're in a recession, technical or otherwise, we're in a recession. And we're going, and we've got 9% inflation, and delinquencies are up 32%. That's not an opinion.
No,
that's a fact.
that's a
They're
fact.
up 32%.
Not to distract, but here's a scenario that will come up again and again in this day and age.
For sure.
And that is over the course of the 4 years, if you're coming up to renewal this year, let's say, or whenever you're coming up. But when you entered into that mortgage that you're currently holding, you were employed by XYZ, whatever. Maybe they did fall into financial hardship, or maybe for whatever, maybe the pandemic was an incentive for you to start your own business and work from home. So now I'm in a whole different situation. I was good, I qualified for the mortgage. They don't really know because I haven't had to tell them, but as long as I made my payments. Now I'm come up for renewal, and I'm running my new business from home with every bit of confidence that it's going to be successful, but I'm in that startup phase in that. How am I going to be looked at differently by my
Yeah, it's a great
lender?
question.
And I'm sure there's a lot of people nodding in agreement with that and going, that's me.
Well, again, let's go back to facts, okay?
Yeah.
During the pandemic, we saw more people say, hey, I'm enjoying working from home and I have no intention of going back to the office, or I'm enjoying my flexibility and my freedom. I'm going to start the side hustle, a gig, right? We talk about side hustle, gig economy, a lot of people driving the ride share, a lot of people delivering, a lot of people starting their own e-commerce business out of their basement, et cetera, et cetera. Remember this, when you've entered into a contract for what everybody has agreed is your largest purchase you will ever make in your life statistically, that is an agreement that says in the fine print on page whatever, in subsection whatever, that says we reserve the right at any time, if your situation changes, we can call the loan.
Yeah.
That is on page whatever of paragraph whatever, right? So for all of those people who did that, first and foremost,
Are you penalized if you didn't tell them about that change?
oh, absolutely. Well, you're liable.
Because you're gonna have to.
You're
There's
liable.
a day of reckoning when you go to renewal.
Well, and that's just it. So
Yeah.
so a lot of people say, I'm just going to keep it quiet and I'm just going to make my payment. It's the same thing with the insurance industry. If you essentially lied in your disclosure to the insurance company and they find
It's
out
null
later,
and void, yeah.
it's null and void. You are not protected,
Yeah.
right? So if you're renting out your house and it burns down, and it was not because of you, but they found out that there was a renter in there and that renter had a cooktop or something like that, or they smoked, you're not covered.
Yeah.
And you're in trouble, right? Or there's a likelihood that you're not covered and you're in trouble. So yes, one of the big mistakes that people have made that I've seen, and maybe we should do a bloopers kind of an episode, but people find out that they got qualified for home and they're like, awesome, I'm going to go buy a new car that'll look good in the driveway of my new home.
I had a people couldn't close because he bought a new F-150 the Harley Davidson edition, literally the week before closing on a $500,000 home, which at that time a $500,000 was the $1 million home today.
Absolutely.
But yeah, literally the week before.
So we're going to talk
To celebrate their pending home purchase.
I love your question. I'm so glad that you asked that question. When we come back from the break,
let's
we're
touch on
actually
that.
going to talk about what do I do now.
Yeah.
And the what I do now falls really, we'll pick up on where we left off on that question
What we
about
do
I
now
started a
and
business.
where it takes us, yeah.
Exactly. So stay with us. We'll be back to cover more about really what do I do now that things have changed and what's my reality and what should I plan for tomorrow. So stay with us for more of Hitting Home with
Arif's
Mike
going
and
to
Arif.
catch his breath and we'll be right back.
Exactly.
Welcome back to Hitting Home with Mike and Arif. And I don't know about you at home, but I'm just enjoying a lot of this and getting a lot of good information. And when we led up to the break, we have talked about where we were, how we got to where we are, and now it's the reality check segment of the show. Where are we now? I think specifically we were talking about what do I do if this is my reality? And we were talking about the gig economy, people working from home, and you wanted to finish up a few points on that too.
Yeah, Mike, humans are really interesting.
Are we not?
I was going
Yeah.
to say humans are interesting people, but there you go.
We are.
If nothing else, you got that out of this show. But no, we're interesting creatures because we go and we seek advice usually when we're in trouble or when there's a critical moment, but we kind of have a tendency to be like, that's great information for that person, but not necessarily for me. And
I'll
so
never
now
need it.
we
Yeah.
find ourselves in this scenario, and there will be people for all the right reasons saying, why are you penalizing me? Why is my life so difficult? I've done what I had to do to protect my family and to survive. Hey, listen, you cannot say that nobody told you this advice before.
Nobody said
We've been
it'd
here
be
for a
easy.
few years. All the information is there. You've got to decide to actually put it into practice for yourself. And one of the biggest things that we as humans do is we compare ourselves to what our friends have, we compare ourselves to what other people have done, but other people have different realities than you and I do.
Yeah.
And so it's so important to take into consideration, these are the facts, and I'm going to have to live within this agreement, this contractual relationship and agreement that I have with my credit card company, with my car financing company, with my kids. I've got to make decisions. I want to put my kids in extracurriculars, and I want to be known as a good parent, and or a good guardian or whatever, and I want to offer my children these nice perks, etc. But at some point, you're going to have to face the hard facts of reality. And the hard facts don't necessarily mean the bad facts, the hard facts, the black and white of the facts. So we were talking about before we went to break, what do people do if their situation during the pandemic changed? It's not the bank's fault that there was a pandemic.
No.
You agreed to buy a house. These were the terms that you qualified on, and then the Bank of Canada suddenly, shouldn't have been suddenly, we advised against it, he wasn't listening apparently, changed the rate at a drastic impact. Why? Because we wanted to curb inflation. Why? Because we wanted to make the government look good. Why? Because the government did some dumb things lending out money that they didn't have. Great.
Yeah.
So we curbed inflation. At what cost?
At what cost?
And what expense?
I don't want to get political, but I have heard coming out of the House during question period on one day our finance ministers saying we need to keep interest rates high to curb inflation. Inflation, we need to soften our economy. Our economy is strong. It needs to soften. If it softens, then it puts inflation in check.
Newsflash.
And literally the same week, she bragged that we have the strongest, if not, or one of, if not the strongest economies of the G7.
We don't.
And we don't, but she was trying to make that point. Well, did you not just say that we should be not bragging about that we should be humbling ourselves to that?
Yeah.
So I'm just getting a lot of mixed messages coming both from the Bank of Canada and our federal leadership, and if I'm getting those, everybody else is paying attention.
Well, and this is the thing, Mike, nobody cares about, not nobody, but forget the G7, what's happening on my street?
Yes, exactly.
What's happening at my kitchen table? What's happening in my reality?
Sorry to sidetrack you.
No, that's okay. I think it's relevant, and I think people need to stop reading those headlines. We're the strongest in the G7. Great. Is that putting food on your table? Is that paying your bills? Or what's your actual reality? So when you choose, let's get back to your point before we went to the break because we don't have a lot of time. When you choose for all the right reasons in your mind to switch your reality and go into the side hustle, this gig economy, or start a business. Because I've always wanted to run my own
business, and now's the time.
You still have to qualify. Just because you think you own your own home, you don't. Until you own nothing, you're on the hook. You have to qualify to stay in your home because you made a promise. And they will hold you to that promise.
So,
and by the way,
doing? Let's put it to the question.
If they find out. Right?
Let's put it to a question. That day of reckoning will come when I have to renew. If I haven't been totally upfront and transparent with my lender as those changes happen in my life, I will have to on that day or
what do I have to do?
So what do I need to do to protect myself, keep my family in my home, not lose my home because I'm now working in my new work from home business, Mike Montague.
Let me rephrase that a little bit, Mike, because I'm not going to speak to the person who goes and does it wrong and then is asking for help just yet, because that's maybe a different conversation.
Sure.
You want to start your own business? Great. Do it after hours. Keep your job.
Right.
Because you have to have, in order to stay at a similar contractual relationship with your lender, you have to keep a similar relationship with them. So if you're going to go start your own job, if you were self-employed, what would it take for me to qualify for this house? They're going to likely want to see 2 years of tax returns where you're probably making a profit. A
good positive cash flow,
Your credit still has to be good. All those kinds of things. They're going to check on your debt servicing. So if you're thinking about starting a new business, great. Can you keep your job and add it? Because if not, you need to take that into consideration. You need to have a conversation with an agent or broker that says, what are the implications? Maybe call your lawyer. What are these implications if I want to do that? Because if you're if you're anywhere within 2 years of your term of your mortgage coming due, you're going to need those 2 years. And now, that's not a hard and fast rule.
All right.
There's a plan B sort of scenario.
Well, that's what I want to get to, because I don't want to just scare people to death here who may be in that situation and they think there is nowhere they can turn.
Great.
Tell us where we can turn.
Let me tell you.
And there's a price for that. But.
Well, there you go. Let me tell you what I share with people who come in self-employed. There are people who come in self-employed, and here's the reality. If you are an employed, you typically get a T4, you get your NOA, you file your tax returns, et cetera, and it's pretty standard issue. Now, of course, there's extraneous circumstances if you've got something else going on in your world. But if you're self-employed, you either file your taxes or you have a really good accountant who files your taxes, and your accountant's job is to mitigate your tax implication. That's their job. Now, you may not like what I'm saying, but ask any accountant. Their job is, my job is to report on the facts, but to use the tools within the tax code to mitigate or reduce any tax exposure, which often means reduce your actual income. So your company might make, let's use a round number, $100,000, but you claim that you earned $40,000 because you wrote off a bunch of expenses. Your company only paid you a certain amount to keep you under a tax threshold or one of those call it a tax threshold. Now, that's great. You paid less taxes, but now you want to buy a home, or now you want to requalify to stay in your own home. The bank's going to say you have a $500,000 mortgage and you're only earning $40,000. This doesn't add up.
No.
So here's your option. Your option is to do one of two things. Pay more to the government in taxes because you declare a different amount, because you pay yourself a different amount so you can qualify, or you might be forced to go and look at an alternative lender who doesn't care about the actual reported tax taxable income. They're allowed to do that. It's their business. But they might have different qualifications. They might become an equity lender.
Yeah.
Or they might say, show us your taxes and we'll go off your gross revenue. Because we're a common sense lender is what they'll call themselves, or something along those lines. But be prepared to pay for that. So what someone might be paying 2.5% on interest for their declared income, fully qualifying rate, a self-employed person looking at alternative lending rates today, today might be qualifying at a first mortgage for 9.24%.
Wow.
Now, sorry, let me requalify that. Today's rate, they might that same person full qualifying might be paying between 4.85 and 5.25%.
Yeah.
But someone who's using alternative lender might be paying around 9%.
Yeah.
So
that's a big jump. That's more than double. Yeah.
So the question is, you're coming up for renewal, and now you've changed your world. You decided to get a job. You're going to have to declare this, otherwise you're offside with the law. You put yourself in great jeopardy. And you might be looking at, well, what am I going to do now that I'm in this transition period? You might be looking at it. Now, someone will say 9.25, that's a crazy percent to pay on my mortgage.
Yeah.
Yes. So go back to your accountant, declare the full $100,000 or $200,000 in income,
Yeah.
pay an extra percentage of income, pay 40% more in taxes, or pay the 9.25.
Now, what about the person who did fully declare that income, did get the bill for the taxes for the full amount, but possibly didn't pay their taxes, and they're behind in paying their taxes? When they walk in the door for that mortgage, do they need to be totally debt-free on their taxes?
Yeah, we got to wrap this up, but I'll summarize it in 60 seconds or less.
Yeah.
The only person or entity that can trump a first mortgage or a second mortgage, like a second mortgage would be a first mortgage, the first mortgage would be the government.
Yeah.
So if you haven't paid your property taxes, or if you haven't paid Revenue Canada, they can come in and do a tax sale or force you to make good. So you are likely looking at, you got to beg, borrow, and steal from family. You got to increase your income. You got to sell something. You got to move out of the house, or you're looking at private financing to cover that. And there are some private financing who will say, we'll give you the money, but we're going to write the check to the government to get you caught up. And now you're borrowing money. So here's the thing, we got to go, Mike. I think we need to really pick this up.
I'll close this out if I can, but go ahead. And I want to say to everybody watching, this is all great advice you're getting. You want to talk to your mortgage broker, your lender, to get the further details on this, because we've just kind of given a Reader's Digest version of a few.
There's always details.
There's so much more, and there's so much more. I know if we were a 2-hour show, we could fill that extra hour.
We're going to have to come back and talk about it,
sure.
but we do have to go. So thanks for joining us on Hitting Home with Mike and Arif. We'll see you again.
Thank you.